You will spend roughly 90,000 hours of your life working for money. And here's the terrifying part. Almost nobody ever teaches you how money actually works. You get 13 years of school, and not one class on the thing you'll spend the rest of your life chasing. So the game gets played on you instead of by you. Banks quietly use your cash. Inflation quietly eats your savings. And a 3-digit number you've never seen decides whether you get a house. In the next 12 minutes, I'm going to fix that. 10 concepts. No boring textbook language. By the end, you'll understand money better than most adults twice your age. Stick around for number 8, because that one is the difference between being broke and being wealthy. Let's go. Pop quiz. What is money? Most people say paper or coins. Wrong. Here, watch this. Take a $20 bill. Now take a random leaf off a tree. Both are just stuff. One can buy you a pizza. The other gets you weird looks at the cash register. So what's the difference? Nothing physical. The bill isn't magic. It doesn't smell like power. The only reason it works is that everyone around you has agreed to pretend it's worth something. That's it. Money is a shared hallucination that happens to be really, really useful. Before money, humans traded stuff directly. I've got 2 chickens, you've got a spear, let's swap. The problem? What if you want my chickens but I don't want your spear? The whole thing collapses. Money solved that. It's a middle step everyone accepts, so nobody has to lug chickens to the market anymore. Governments print it. Central banks control how much of it exists. And you and I trade it every single day for stuff we actually want. Dollars, euros, Bitcoin, seashells, cigarettes, in a prison, it's all the same trick. Value only exists because we all agree it does. Remember that, because it's the foundation for everything else. Ask your grandparents what a candy bar cost when they were kids. They'll say something insane like 5 cents. Today, $2, same candy bar. Recession happened. Inflation happened. Inflation is when money slowly loses its power. Your $100 bill still says 100, but every year it buys a little bit less. Less gas, fewer groceries, a smaller bag of chips that's somehow 40% air. Where does it come from? A few places. Sometimes there's just too much money floating around. Everyone's got cash, everyone wants the same PlayStation, so sellers go, cool, I'll charge more. Sometimes it's the supply side, a factory shuts down, oil gets expensive, and the cost of making everything creeps up. And sometimes it's pure vibes. If people believe prices are about to jump, they rush to buy now, which makes prices jump. A self-fulfilling prophecy. A little inflation around 2% a year is actually healthy, predictable, boring in a good way. But when it spikes, your savings quietly bleed out while you sleep, which is exactly why letting your money sit in a shoebox is one of the most dangerous things you can do with it. Keep that in mind. We'll come back to the fix. Interest is the single most powerful force in your financial life, and most people never respect it until it's too late. Here's the one-sentence version. Interest is rent for money. When you borrow, you pay rent for using someone else's cash. When you save or lend, you collect rent for letting someone else use yours. Now, here's where it gets spicy. There are 2 kinds. Simple interest is a flat fee. Borrow 100, pay back 110, done. Compound interest is where the magic or the horror lives. Because with compounding, the interest itself starts earning interest. Your money has babies, and then those babies have babies. Let me show you both sides. Bad side, you miss a payment on a credit card charging 24%. Now you owe interest on your interest. That $15 pizza you swiped for slowly mutates into a $60 problem while you're not looking. Good side, you invest $100 at around 8% a year. It doesn't just add up, it multiplies. Give it enough time and that snowball rolls downhill into something enormous without you lifting a finger. So the rule is stupidly simple. If you're paying interest, kill it fast. If you're earning interest, leave it alone and let it cook. Interest is either your worst enemy or your best employee, and you decide which one just by which side of it you're standing on. You probably think a bank is a giant safe. You hand over your money, they lock it in a vault, and it just sits there waiting for you. Cute. Completely wrong. The second you deposit $1,000, the bank doesn't tuck it away. It lends most of it out to someone buying a car, a house, a business. Your money is out there in the world right now, doing stuff. The bank only keeps a small fraction on hand, betting that not everyone will show up demanding their cash on the same day. This is called fractional reserve banking, and 99% of the time, it works fine. The exception is when everyone panics and rushes to withdraw at once a bank run. That's a huge part of what blew up in 2008. So why keep your money there at all? 3 reasons. It's safer than cash under your mattress. It's more convenient. Try paying for anything online with a wad of 20s. And they actually pay you a little interest just for parking your money with them. The bank's whole business model? They pay you a small interest rate to hold your money, then lend it out at a higher rate. The gap in the middle is their profit. You're the supplier, the borrower's the customer, and the bank is just the matchmaker taking a cut. In a lot of countries, your deposits are also government insured up to a limit, so even if the bank collapses, you're protected. Not a bad deal for something we all assumed was just a fancy safe. Picture your first real paycheck. The offer said $2,000. You open your account and there's $1,500. Where did the rest go? Welcome to taxes. The toll you pay for living in a functioning society. And look, I know taxes feel like getting robbed by someone who then expects a thank you card. But that money is what builds the roads you drive on, the schools you sat in, the hospital that'll patch you up, and the inspector making sure your favorite restaurant isn't a science experiment. There are a bunch of flavors. Income tax hits the money you earn. Sales tax hits the money you spend. Capital gains tax hits the profit your investments made while you were literally asleep. Then there are contributions toward things like retirement and public health care, quietly skimmed off every paycheck. Here's the part that drives people crazy. In many countries, the government already knows what you owe, but they make you calculate it yourself and guess. Guess right, you're fine. Guess wrong, and you might get a very unfriendly letter or worse. The takeaway isn't taxes are theft. It's know how they work, because understanding them legally keeps more money in your pocket. And generally, countries that tax more also tend to have higher quality of life across the board. The relationship's messy, but it's there. Somewhere out there is a 3-digit number that knows you better than your friends do. It knows every bill you paid late, every card you maxed out, and it quietly decides whether you get a house, a car, or a brutal 27% interest rate. That's your credit score. And here's the twist most people miss. It has almost nothing to do with how much money you have. It's about one thing: trust. Lenders want to know, if I hand this person money, will they actually pay me back? Your score is their answer. It usually runs from 300 to 850. Down near the bottom, you're a red flag lenders run from. Up near the top, banks roll out the red carpet with their best rates. So how's it calculated? A few things. Do you pay on time? That's the big one. How much of your available credit are you using? Are you constantly maxed out? How long have you had accounts open? Do you have a healthy mix of credit types? And have you applied for a bunch of new stuff all at once, which looks desperate? Here's the wild part. You can have 0 debt and still have a trash score, because if you've never borrowed anything, lenders have no proof you can be trusted. The system doesn't reward being scared of money. It rewards using it responsibly and paying it back on time. Treat your score like a plant. Ignore it and it withers. Water it consistently, and one day it helps you buy a home. Every few years, the economy throws a tantrum. That's a recession. Technically, it's when the economy shrinks for about 6 months straight. But in real life, it looks like this. Layoffs everywhere, the stock market bleeding red, and everyone suddenly clutching their wallets, buying only what they need. Why does it happen? Lots of reasons. Interest rates climb too high and borrowing gets too expensive. A global shock hits a pandemic, a war, a supply chain meltdown. Or sometimes it's just the natural rhythm of the economy. Boom, peak, bust, reset, over and over, forever. Think of the economy as a party. In the boom, everyone's dancing, spending, feeling rich. Then the lights flicker, someone checks their bank balance, the mood crashes, and everyone goes home. That's a recession. But here's the important bit. Recessions are not the end of the world. They're painful resets. Governments usually respond by cutting interest rates and pumping money back in to get people spending again. Eventually, confidence returns, businesses rebuild, and growth picks back up. The cycle always turns. Knowing that is what separates people who panic sell at the bottom from people who stay calm and come out ahead. This is the one I told you to wait for. Here it is. Remember inflation? Quietly eating your savings? Investing is the antidote. It's how you make your money outrun the erosion. Normally, you trade your time for money, an hour of work, a bit of pay. Investing flips that. You put money to work so it earns more money, even while you sleep, eat, or scroll your phone. Your dollars go get a job. What can you actually buy? A few core things. Stocks, tiny ownership slices of companies. If the company grows, your slice grows with it. Bonds, basically, you loan money to a government or business, and they pay you back with interest. Funds, big baskets of stocks and bonds bundled together, so you're not gambling on one single company. And real estate property that ideally someone else pays you rent to live in. Now, the honest part, investing has risk. Markets go up, markets go down, and anyone promising guaranteed riches is lying to you. But here's the thing, almost nobody realizes the bigger risk is never investing at all and letting inflation silently drain your future. And the secret isn't being a genius or getting lucky. Most wealthy people didn't win the lottery. They were early, they spread their money out, and they were patient. They just handed compound interest a couple of decades and let it do the heavy lifting. Which brings us to the two final concepts, the ones that tie everything together. Here's the concept that unlocks it all. Value. Pick up a plain gray rock. Worthless. Now picture a shiny gold nugget. Suddenly it's worth a fortune. But gold isn't actually more useful than that rock. You can't eat it. It won't build you a house. It's worth more purely because humans decided it is. Value lives in people's heads, and this is the entire secret to earning money. If you provide a lot of value to a lot of people, you earn a lot of money. A doctor gets paid well because saving lives is enormously valuable. Someone builds a phone that 1 billion people love, and 1 billion people gladly hand over their cash for it. It's also why a luxury brand can sell basically the same handbag as a cheap store, but charge 100 times more. People perceive it as more valuable, so it is. Perception becomes reality. So, if you want to make money, stop asking, how do I get paid? And start asking, how do I create value for other people? Solve that, and the money follows. Last one, and it's the most important thing I'll say all video. Time is the most valuable asset you will ever own. And here's the beautiful part: if you're watching this young, you're rich in the one thing money can't buy back. Most people trade time directly for money. 1 hour, 1 paycheck. Simple but limited, you only get 24 hours a day. The people who get truly wealthy figured out how to make their time worth more through skills and leverage. But nowhere does time matter more than in investing. Because wealth isn't built in days, it's built in decades. A small amount of money, invested consistently, left alone long enough, doesn't just grow, it explodes. That's how an ordinary person with an ordinary paycheck retires with 7 figures. They didn't beat the system. They used time, the one weapon they had the most of. So, here's my challenge to you. Start now. Start small. Understand these 10 ideas, let compound interest and time do their quiet work, and future you will be so glad you did. If you learned something, you know what to do. Now go build something.